Hello, everybody. I hope you had a great 4th of July yesterday. We're ready to begin. Hope you guys did something fun. Was able to enjoy celebrating the birthday of the country. Hopefully, everybody put politics aside for one day and have a super nice day. And you guys go to the beach and all that kind of stuff? Any beach people? What do you guys think? Backyard barbecue? Backyard barbecue, anybody? All right. There you go. Long Beach on a boat. Okay. So with that being said, let's get started. Yeah? If you want to get started, give me a thumbs up. Now, keep in mind, today I'm doing 2, all right? I'm doing 1, then I'm taking an hour break. I'm going to do another one. The reason I'm doing 2 is because tomorrow I will not be doing one, and next week's going to be a little bit on and off with the webinars as I'll be traveling. This is why I have to find other people to help. But after next week, we're going to be back on a regular cycle. Maybe I'll try a different time, but it'll be pretty regular. So that's why I'm doing 2 today, because next week's going to be a little bit hit or miss. So I just want to give everybody that heads up so everybody knows in advance. All right. Okay. Let's get going. What's the top? What topic for later today? Honestly, I didn't even look. I just log on and I just see. Anybody know what topic I'm doing at in 2 hours? Anybody know? Not sure. I'm doing finance right now, though. As I said, now that I've gotten the groove doing this every day, I just log in and whatever topic's there, rock and roll. Okay, agency. Right now we're doing finance. Okay. All right. So right now we're doing finance. All right. So when a lender speaks of discounting, the lender is probably referring to A, the loan proceeds dispersed by the lender are less than the face value of the note. B, the process of determining the actual yield of a given loan by adjusting the variable interest rate. C, the process of determining the effective interest rate. Or D, the nominal interest rate and the effective interest rate are on a specific loan. What do you guys think? Okay, and the answer is A, the loan proceeds are dispersed by a lender are less than the face value of the note. When you talk about discounting, you're talking about paying it down. All right, you're kind of making it a little cheaper. Does that make sense? You're paying it down, so you're paying less over the longer term. When loan money to 2 or more co-borrowers on a single promissory note, the lender would be best advised to increase the security on the note by inserting which of the following phrases after the names of the co-borrowers? A, individually and severally. B, personally and corporately. C, jointly and severally. D, together as individuals. Okay, jointly and severally. Okay, that means that two or more people could be responsible for it. All right, so lenders have two people they could go after. All right, and that would increase the security. So not just one person is responsible. There's two people they could go after. Does that make sense? So obviously the lender has more confidence in the loan when there's more than one person they could go after for the money. Okay, moving right along. The open-end clause in a mortgage would benefit the borrower the most if he A, had a loan subordination to a construction loan, B, borrowed additional money, C, prepaid the loan, D, allowed a subsequent buyer to assume the loan. What do you guys think? Okay. Open end, so Brooke, open end means get another loan. It just means you could borrow more, you can add on to it. Think of it like a credit card. Think of it like a credit card. That's what that means. An open end loan is kind of like a credit card. Okay? It's kind of like a credit card. The type of mortgage loan which permits borrowing additional funds at a later date is called. Oh, did we just do this one? Is this a repeat one? Let's do this one again, even if we did. The type of mortgage loan which permits borrowing additional funds at a later date is called A, an open mortgage, B, an extendable mortgage, C, a junior mortgage, D, an equitable mortgage. Okay, everybody get this one right really quick. Good, because we just did this. Just realize it's a similar question, but it's different options. All right, but we all got that right super quick. Good. When the term beneficiary statement is used by those in real estate finance, it identifies a statement made, A, by the property owner listing the beneficial features of an assumable loan, B, by the insurer stating the amount that will be paid for the policyholder if the improvements are destroyed, C, by the lender as the current balance due to pay off a real estate loan, D, a designation designating the one who will receive the property in the event of the borrower's death. Okay, C, by the lender as to the current balance due to pay off a real estate loan. Okay, moving right along. The measure of goods and services produced by a nation during any one calendar year is called A, national economic cycle, B, cost of living index, C, gross national product, or D, national income. All right, good. That's an easy one, right, guys? Okay, we'll go over that one again. I have all the ones we got wrong saved on that right-hand column, so don't worry, we'll have a chance to look at them again. The majority of money used for loans of real estate comes from A, individual savings, B, co-op savings, C, government bonds, D, Federal Reserves. A, individual savings. Good. So the individual savings comes from, normal people like you and I when we put money in the bank. Okay, when processing a real estate loan application, a lender would correlate characteristics of a borrower, loan, and property to make A, a property appraisal, B, a liability statement, C, a credit rating, D, a loan commitment. Okay, a lot of you guys are writing C, some D. So what do you guys think? C or D? C or D? Ready? So I see the majority of you click C. And it's D. Oh, so Red Pill Rich and Linda. Oh, and Sherry, got that right. Okay. So this also to do with the loan commitment. They're talking about the lender's desire to lend you money. If or if not, they want to do it. Okay. So that property and the characteristics of the borrower, the characteristics of borrowers, like the FICO score, things of that nature. Okay. And the loan on the property, has to do with the property's value. C is your credit ratings. That is the character. The lender looks at your credit rating and see if you want to make me a loan, if they want to give you that loan commitment. A loan commitment is their decision to lend you the money, their decision to actually put money in your hands so you could buy a house. Okay, a takeout loan in real estate financing is A, a loan that calls for payments to be made in intervals. B, a long-term loan to replace a construction loan. C, a short-term loan generally to finance construction. D, the amount of net proceeds actually available to the borrower after the deduction of the discount points and prepaid interest. What do you guys think? Okay. So everybody write this down. Okay, so the answer is a long-term loan to replace construction loan. So everybody write this down. In-term loan, short-term loan, takeout loan, long-term loan. Please write that down. In-term loan, short-term loan, takeout loan, long-term loan. I want all you guys to write that. In-term loan, short-term loan, takeout loan, long-term loan. In-term loan, short-term loan, takeout loan, long-term loan. Okay, if you remember those key words, you could pass your exam. Okay, the takeout loan is that long-term loan. In-term loan is a short-term loan for things like construction. All right, very short-term projects. All right. The term warehousing as used in real estate financing means A, a large bank or savings and loan, B, a mortgage company collecting loans prior to resale, C, unregulated real estate loans, D, the financing of industrial warehouses. Okay, so it looks like you got this is B. It's when you group them up. Think of it like selling a six-pack of soda, okay? When you group them up and sell them in a big group on the secondary market. Do you guys know what the secondary market is? Do you guys know what the secondary market is? Who here knows what the secondary market is? Okay, who can explain the secondary market in 2 words? Nice job, Linda. Resale marketplace. Good job, resale marketplace. Excellent. You guys got to remember that. Secondary market, resale marketplace. Okay. The term warehousing with regard to a mortgage means A, accepting unsecured loans, B, making low interest rate loans, C, making long-term loans, D, selling loans in the secondary market. So we just did that. So I hope everybody gets that right. And the answer is D, selling loans in the secondary market. When purchasing with FHA financing, a new buyer would normally do each of the following except A, apply directly to a bank or savings and loan. B, pay for more mortgage insurance protection. C, apply to a local FHA office for the FHA appraisal. D, buy a home which confirms with the FHA requirements and restrictions. Okay. And the answer is C. What is a FHA loan? What do you guys think? What's an FHA loan? What's an FHA loan? Okay, FHA loan is an insured loan, right? Good job. So you could get an FHA loan, but it doesn't actually mean the FHA is lending you money. It looks like everybody here understands that. So when somebody says they got an FHA loan, the FHA is not actually lending the money. The FHA is just insuring the loan. That's what it means when you get an FHA loan. But it looks like everybody here is on that. Do you need a down payment for an FHA loan? What do you guys think? So when you get a loan that's insured by the FHA, okay, is there a down payment needed? Okay, Brooke says yes, good. Marco says yes, good. Which one of these do you not need a down payment for? Ah, Brooke, you're way ahead of me. All right, the VA. The VA, you don't need a down payment. You're reading my mind. You're reading my mind. Okay, the VA, you don't need a down payment. Yeah, that's correct, Sherry. You don't need a big down payment for the FHA loan, but you still need one. All right, good job. The annual percentage rate, APR, is defined by the Federal Truth in Lending Law as A, relative cost of credit expressed in percentage terms, B, total of all costs which the borrower must pay, only the direct cost of credit paid by the borrower, D, the total of only the indirect cost of the credit which the borrower must pay. Okay. Oh, a lot of you guys said B. The answer is A. It's the relative cost of credit in a percentage term. All right, that's what you guys got to remember. Okay, it's not the total cost. There could be certain fees. Yeah, this comes with Regulation Z and Truth in Lending. All right, it's the relative cost of credit expressed in percentage terms. There can be other fees when you get the loan. Okay, so it's very technical. I know the wording gets a little tricky here. So I just want you guys to remember this one so you get it right on your exam. It's the relative cost of credit in percentage terms. That's what it's all about. All right, so let's look at some of these ones we got wrong before. Okay, when the term beneficiary statement is used by those in real estate financing, it identifies a statement made A, by the lender as to the current balance due to pay off a real estate loan, B, by the property owner listing the beneficial features of an assumable loan, C, by the insurer stating the amount that will be paid to the policyholder if the improvements are destroyed, D, designating the one who will receive the property in the event of the borrower's death. What do you guys think? So a bunch of us got this one wrong, so we're going to look at it again. Okay, looks like everybody's got this right this time. The answer is A. Sophie asked me in 2 words, how could you say it? I think you're talking about APR, right? And APR, the fewest words possible, I'd say cost of credit in percentage terms. That would be the quickest way I could think of to say it. Cost of credit in percentage terms. Cost of credit in percentage terms. I guess that's 6 words. You could minimize that how you see fit. To determine the amount of economic obsolescence suffered by a commercial property, the answer to which the following questions must be relevant. A, are the tenants in the neighborhood prospering? B, should the fire escape be installed? C, is the rental schedule of a building equitable charged to the tenants? Or D, can the building be operated efficiently? Good. I think this one's misplaced. This should probably be in our valuation and market analysis category, but clearly when we organize this, we saw the word economic and we put it in finance. I hope you guys don't mind. Maybe it's just a little one to throw you off. It looks like all of you guys got this right. Are the tenants in the neighborhood prospering? Okay. But since we're here, really quick, what's economic obsolescence? Who here knows? What's economic obsolescence? What do you guys think? What's economic obsolescence? Outside the property lines. Good. What's functional obsolescence? What's functional obsolescence? Who knows? What's functional obsolescence? So it's not outdated stuff. Careful with that one, Brooke. Outdated stuff would be physical deterioration. If you mean by outdated, it's not working anymore, if that's what you mean by that. Functional would be more like poor design, okay? So maybe if you mean outdated by like it's just a bad design, maybe that'd be functional, but careful with that because outdated in my mind means things are just old and not working anymore, in which case that'd be physical deterioration. All right. Okay. And Sophie writes, the house obsolete with today's lifestyle. Yeah, so I guess it all depends. Careful with that one, though, guys. We all want to get that one right. And also remember, they may ask you which of the following is not a form of obsolescence. And the answer there is going to be physical deterioration. People get that wrong because they sometimes think in their mind economic obsolescence, functional obsolescence, physical obsolescence, and they get it wrong in their exam. Just remember, it's not called physical obsolescence. A lot of people make that mistake because they remember all three of them together and they pool them all together. It's not physical obsolescence. It's physical deterioration. Sometimes people ask me things that people commonly get wrong, and that's one of those things. Okay, so I just wanted to give you guys that heads up there. The seller under a land contract is called A, the grantee, B, the grantor, C, the vendor, D, the vendee. The seller under land contract is called A, the grantee, B, the grantor, C, the vendor, D, the vendee. Okay, so the answer is C, the vendor. Good. Givor, proprietor, all right? And you guys know what they're talking about in a land contract? In this type of arrangement, what they're referring to here is when the seller becomes the lender as well, okay? And then the buyer pays the seller installments. It's a type of financing, all right, that the seller essentially is the beneficiary, if you want to use the fancy exam terms. An increase in the availability of money would lead to which of the following? A, interest rates would go down. B, interest rates would not be the affected due to truth in lending. C, interest rates would not be affected due to RESPA guidelines. Or D, interest rates would go up. Okay, and the answer is A. Good. All right, see a lot of you guys hit D. And after this one, we're going to go over those ones we got wrong. So in case you guys haven't noticed, I clicked the answer the majority of you guys click. So the interest and the availability of money would lead to which effect? Excuse me, the increase in the availability of money would lead to which effect? Interest rates would go down. Just think about it. Interest is rent on money. If there's a lot of properties available, the rent's going to be cheaper. If there's very few and the properties are precious, rent goes up. The same thing with the interest. Okay, does that make sense? All right. Don't want you guys to get that one wrong. Okay, now let's go over the ones we got wrong. The Federal Truth in Lending Regulation Z gives the borrower a 3-day right of rescission when the loan is A, an FHA or VA loan to purchase a single-family owner-occupied residence, B, a conventional purchase money loan secured by a deed of trust on residential property, C, a purchase money loan secured by a deed of trust on commercial property, D, a loan secured by a deed of trust on an owner-occupied single-family residence when the money is borrowed subsequent to the purchaser. What do you guys think? So he says B or D. Got to pick one. You guys got to pick one. Brooke says A. Marco says A or D. The answer is D. A loan secured deed of trust. The word here is single family residence. Okay. These laws apply to single family residence. All right. That's the key word there. Right. Okay. When a lender speaks of discounting, the lender is probably referring to A, the difference between the nominal rate and the effective interest rate on a specific loan, B, the process of determining the effective interest rate, C, the process of determining the actual yield of a given loan by adjusting the variable interest rate, or D, the loan proceeds dispersed by the lender are less than the face value of the note. What do you guys think? Dave wrote D. Discounting means you're paying money up front, so you pay less over the life of the loan. So therefore, the answer is D. A takeout loan or real estate financing is A, a loan that calls for the payments to be made at intervals, B, a short-term loan generally to finance construction, C, a long-term loan to replace a construction loan, D, the amount of net proceeds actually available to the borrower after the deduction of the discount points and prepaid interest. What do you guys think? So I see C, D, C, D. You guys remember takeout loan, long-term loan, interim loan, short-term loan. Takeout loan, long-term loan, interim loan, short-term loan. An increase in the available money would lead to which effect? A, interest rates would go up. B, interest rates would not be affected due to RESPA guidelines. C, interest rates would not be affected due to truth in lending. Or D, interest rates would go down. Good. Interest rates would go down. The seller under a land contract is called A, the vendor, B, the grantee, C, the vendee, or D, the grantor. What do you guys think? A, the vendor. Good. We're busting through these last ones here. The annual percentage rate defined by the Federal Truth in Lending Law as total cost of which the borrower must pay to get a loan, the total of only the direct costs of credit paid by the borrower, C, relative cost of credit in percentage terms, D, the total of only the indirect cost the creditor borrower must pay. Remember we talked about before. Nice job, Brooke. Good. Relative cost expressed as a percentage term. When processing a real estate loan application, a lender would correlate characteristics of a borrower, loan, and property to make A, a property appraisal, B, a liability statement, C, a loan commitment, or D, a credit rating. The answer is C, a loan commitment. Good. We're going through a lot of questions today. When loaning money to two or more co-borrowers, a single promissory note, the lender would be best advised to increase the security on the note by inserting which of the following phrases after his names of the co-borrowers. A, together as individuals, B, jointly and severally, C, individually and severally, D, personally and corporately. Okay, Brooke says B. Linda says B. And it's B. Good job, guys. Which of the following does not directly affect the level and movement of mortgage interest rates? A, the rate of unemployment, B, the demand of funds, C, the supply of funds, or D, the inflation rate? A, good. Two more. An accounting term used to designate a payment or owing is called A, a pledge, B, a debit, C, a waiver, or D, a credit. The answer there would be debit. A debit's money you owe. Okay, I understand how you guys may think pledge, but just go with debit. You have debits and credits. A pledge is more like a promise. The Federal Truth in Lending Law, Regulation Z, gives the borrower a 3-day right of rescission when the loan is an FHA, VA loan to purchase single-family owner-occupied residence, a purchase money loan secured by a deed, trust of commercial property, C, a loan secured by a second trust deed of owner-occupied family residence when the loan is borrowed subsequent to the purchase, D, a conventional purchase money loan secured by a deed of trust on a residential property. Okay, the answer is C. I'll look into that one a little more. That one is tough. And I believe you don't have that right of rescission on FHA or VA loans, but I will look into that more and I'll try and find a better explanation for you guys later. That one is tough. I agree. That one's a little tricky. But they all can't be easy, right, guys? All right. So with that being said, I'll see you guys here in an hour and 20 minutes. All right, hour and 20 minutes. And other than that, I hope you guys have a good day if you're not going to be with us. But I'll be doing another webinar in an hour and 20 minutes, right? Because I won't be doing them tomorrow. Okay? How many of you guys will I see a little bit later? Any of you guys? All right, so I'll see Kathy then, and maybe some of the rest of you guys too. All right, talk to you guys later. Thanks.